I'm going to take the first $40,000 and I'm going to test these three things. And I'm going to measure these three things in this way. Those are the only metrics that matter.
Yep.
That's it. And you're using that pre-seed capital to test and iterate until you find the model that makes the most sense. I am so excited. We've been talking about this for longer than I can remember.
For a long time.
About time.
Yeah. So we're going to talk about we'll get to the punchline real quick, and then we're going to kind of back up and do some preliminary info for everybody. But we're going to talk about a topic today that we believe has exponentially grown in the critical nature for every company to attack it right now. With the recent proliferation, we heard about AI for years, 5, 6, 7 years. Nothing really ever happened. And then the last 6 or 9 months, it has just exponentially increased. The AI agents, modern technology, it just has proliferated every facet of every sector faster than ever. And that is the need to get control of your data. When we talk about data hygiene and financial hygiene and the intersection of those two components, it's literally like a matter of life and death for companies today.
Yeah. I think if we thought starting and scaling a technology business or an innovation-driven enterprise was hard before, just imagine now.
Yeah.
In the next 3 to 5 years, what the introduction of AI, the ability to prototype faster than ever for cheaper than ever, to pivot faster than ever for cheaper than ever, the impact that has, especially on existing businesses today.
Yeah.
The time is now to understand what's going on in your business, to understand what levers you have to pull to remain competitive.
So before we dive into that, let's give the listeners, the viewers, just a little bit of context and background where we are coming from. So we're at Elevate Ventures. Elevate Ventures, '1 most active investor in the Great Lakes region, top 20 in the world. Since inception, Elevate has looked at over 7,800 companies, and we've advised 4,228 companies, and that has transacted with over 1,125 transactions into over 600 companies across 18 funds, 15 years, 4 sectors, so cross-sector. So what we're going to talk about today is it applies to anything. And then my personal background, serial entrepreneur, right? 8 businesses, 7 verticals, over 27 years. And maybe share a little bit about your background.
Yeah, sure. I actually thought I was headed to Wall Street, ended up in public accounting right around the time of the Great Recession. I spent 2 years there. Really created that foundational understanding of financial statements and the importance of understanding what has happened in your business to be able to forecast what will happen going forward. Was employee number 8 at a big data marketing tech startup, spawned out of ExactTarget in 2011. Got to scale with that organization, all back office functions, of course, finance, ops, data, what we're going to talk about today. But got to see fundraising from an angel lens all the way through Series C, through a merger during COVID. Not enough time on this one, but would love to share my experience there. Selling a company when you haven't met the acquiring management team is an experience all its own. Spent 2 years scaling that organization post-acquisition before coming here. And I remember one of the first conversations we had before I started at Elevate, and one of your theses being applying operational acumen and experience to investing.
Yep.
Attracting operators to jump across the chasm, serve on this side of the table, to enable entrepreneurs to better understand what investors are thinking, and what a platform we have here at Elevate to be able to do that.
Yeah, there's some misunderstandings, it seems like. So, all right, well, we're going to pop up we have 2 slides we're going to talk about today. And the first one we're going to pop up is going to be this concept of data layering. And hopefully everyone can see that. If you're listening to this, you won't be able to see it. So we'll kind of explain what we're looking at. If you're watching a video of this, hopefully you're able to see the screen of the TV clear enough. And before we always want to give credit. So I first saw this on LinkedIn. So Jeremy Spiker, a go-to-market advisor and fractional leader for VC and PE-backed startup and scale-ups. So I'm not sure if Jeremy actually created this visual or if it was someone else, but I did see it on his LinkedIn. And I just liked how it kind of crystallized the thought process. And so as we jump into this, what we're looking at here is we're looking at 5 layers as you think about data. And what really struck me when I first looked at this graphic was typical entrepreneurs when they start, and this is where I think investors actually do a disservice sometimes to the entrepreneur, to the founders, or the executive team, management team. But we all jump to CAC and LTV and, ARR and all these kinds of things, Rule of 40, all these kind of things. There's also a new measurement out for that here recently. But it's like Monopoly, right? Like we actually should not pass go in this situation. And so let's start off with the first layer, which this talks about data model, like data hygiene. When we use this terminology, data hygiene, like what do we mean by that? And why is it critical to start with the granular data first?
Yeah. And one thing, as you were rattling through, elevates complexity on our end, our own data model. We are also multi-stage. And so when we answer this question, I'm going to talk about
cross-sector multi-stage.
Yeah,
right?
It's really important that we think about like pre-seed, pre-revenue, what's really important to understand. And as we move through that funding continuum, and now we're raised our first $1 million or $2 million, and then we're gearing up for Series A, typically where you have some semblance of product market fit, and now you're ready to go attack a distribution model that you think's really going to bear fruit, right? What kind of metrics, how does that evolve over time? To your point, I think as investors, we dump a lot on the entrepreneur in the form of pitch deck templates and all types of things to go read that jump right into acronyms that they don't understand. Right.
That's right.
And like really, if we could distill it down, especially the earlier in pre-revenue you are, what do we actually care about? Like money coming in and money going out. Like everything is distilled down to that. And this concept, what I really like about this bow tie model and that fifth layer being your sort of underlying foundation or infrastructure is like you can only change things that you measure or track. And this makes you think about what's important to the business at that stage as it relates to cash at the end of the day. And then you build on top of that an understanding that evolves and matures over time. We don't care about LTV to CAC if you're not generating any revenue.
Right. That's right.
It's irrelevant.
That's right.
Right? You're going to make a bunch of assumptions and that number's going to change over the next 2, 3, 5 years. It doesn't matter. But we do need to know how fast you pay your bills and how you decide to prioritize them, especially if you're pre-revenue. Our investment dollars are going to that function initially. And so thinking about some of the complexities that exist in acronyms and big words that founders and entrepreneurs struggle to understand and distilling them down to simple things like how long did this take? Literally taking your phone out, starting a stopwatch, and doing something. How long does it take you to write an email? How long does it take you to address a support ticket? What types of support tickets? Just time them. We don't need AI to do that. We need to get comfortable in measuring things so that we have a better and deeper understanding of how our business works.
I love that. So as we walk through this today, just so for the folks who cannot see the screen, we're going to walk through the data model, so the most granular data model, then data structure. So it's like you think about controlling your data from day one, and then you go to market, and then you start measuring the performance of all those go-to-market activities. And then you get into the strategic piece of your business, and the last component is ultimately the metrics that you measure and show to investors, right? And to your point earlier, that changes drastically at each stage. So let's start off with that granular data model. And this, we've seen this, to your point earlier, not only apply to if you're starting a company at pre-rev, but you could be a 10, 20, 50, $100 million company. And in fact, I think there's probably public companies out there who have not gotten control of their data yet. And there was a recent McKinsey study out there that said they thought that 25% of the companies were ready for AI, where they had their data under control, their data structured. And gosh, I wish I could remember who it was. There was another company that had done a survey, and they thought that number was 2%. And as one of the most active investors in the world, I think we would say that that's probably closer to 2%. Maybe. For sure, it's not 10%. And because entrepreneurs are so busy, right? You're squirrel, right? And so entrepreneurs are so busy focused on a bunch of stuff, and they forget about the granular things. So let's talk about when we're first starting off, your pre-rev, and at that stage, really, it's about the founder, it's about the jockey, the people, right? But let's talk a little bit about that most granular level at the kind of the pre-rev stage, and let's kind of jump up to if you're doing 20 million.
Yep.
So people can kind of fill in the gaps in between. But like going out and getting your first, like one thing I saw the other day, somebody was talking about pre-rev startups, what you should be doing for marketing.
Right.
Probably zero. Like go get your first customer, and then 5, then 10, then 100, and get really super happy customers. So how do you think about what are those most important things at the pre-rev stage that people should be focused on?
Yeah, so when I'm talking to pre-seed entrepreneurs, I usually have 2 types of conversations. The first is to make sure they intimately understand just how expensive venture capital is.
Yes.
Okay. Assuming they wrap their mind around that, and they're convinced that venture capital is the way. Then we shift into really what the purpose of pre-seed dollars are. Pre-seed dollars are there to test hypotheses. That's it. Be super clear about what the things are that you need to go learn about. Distribution model, product market fit, how you interact with a team member. All of these things play, and they must be measured. The simpler we keep it, I'm going to take the first $40,000 and I'm going to test these 3 things. And I'm going to measure these 3 things in this way. Those are the only metrics that matter.
Yep.
That's it. And you're using that pre-seed capital to test and iterate, test and iterate, test and iterate until you find the model that makes the most sense. And you're ready to raise real capital, right, to the tune of a couple $100,000 up to $1 million or $2 million to continue scaling that idea.
One thing that I think it's interesting, like you probably don't want to raise venture capital until you get to your first aha moment. And that has never been more possible until now, right? With all the different AI tools out there, you should be able to spin up literally in a day or a night or over a weekend some first version of a product to go out and test your thesis, your hypothesis for what pain you're solving,
right,
in a matter of literally a day or 2 or 3 to try to get to an aha moment. And you're going to have to beat that up a few times, a few cycles, before you even think about raising any money at all.
Yeah.
Do you think we've seen entrepreneurs at scale adopt this concept of all these AI tools that are out there and available for them?
Absolutely not. But you and I talk about all the time, we talk about what makes the best founding team. You got to have someone that can build it and someone that can sell it. And you often say you got to have someone that can sell it and someone that can build it.
Yeah.
Well, the profile that you don't see a lot, and in fact, the profile that we're talking about the most today is the operator.
Yep.
Right?
Yep.
You need someone that can sell it and someone that can build it.
Yep.
So to take advantage of what all of these modern tools allow for, you're either the seller or the builder. And we can get to, over time, the importance of that third profile, the operator. But no, I don't think they are.
There's a concept that's come about, like the software composer. I wish I could remember who I was talking to the other day. They don't have any development skills. And they literally stood up a prototype of a product, just leveraging. And I can't remember. I think they used Bubble, but I have a friend that stood up an awesome product, and it may not scale to enterprise level. He'll have to do some additional things in the future, but it's going to give him the first 10,000 customers, and used Bubble and Exana, right, to build this product, and used no developers. And he knows a little bit of code.
Yeah.
But I think that's like step one is. You got to start today. It's more critical than ever. You cannot build software like we did even 3 years ago.
Just think about what you'll save when you go to the enterprise build.
Right.
Right. How much money did you spend on ideating and iterating before even getting to the code base?
Yep.
With the contracted development partner or the in-house team that you paid full boat for.
Yep.
That all goes away when you can iterate in real time with your customers on the call.
You know, one thing that just popped in my mind. Will we see the historical CRM disappear?
It's our head of BI here at Elevate and I talk about this all the time, right? Salesforce has been around for 25 years.
Yep.
Like 25 years from now, probably not. Are we 5 years away? Are we 10 years away? Right. And they may reinvent themselves, right? This is not to say that they're going to get stuck in the mud. They may reinvent how we think about the world, but more so than ever before, our access to data and understanding is right at our fingertips, and we don't have to be ex-accountants, ex-financiers, ex-biz ops people to get there.
Yeah.
In the same way that you don't need to have coding experience to prototype and iterate an early version of a product.
All right, so let's move into a little bit into data structure. So this talks about time metrics, volume metrics, people cost, campaign cost, conversion metrics. So in those very early days, the most important thing are customers.
Yeah.
Does somebody want what you're building, right? Are you building a solution to in search of a problem?
Yeah.
Or are you actually just solving an actual pain point that people are willing to pay for?
Yeah.
And the idea of going narrow and deep. And so, and I want to dovetail into the very early stages of a financial model as well. And so at this stage, you are thinking literally about the basics of block and tackle. How many phone calls do I need to make that I can get the first person to return my phone call and hear my pitch and say yes or no, I want to learn more? And then are they willing to actually use it?
Yeah.
For free, maybe, right, at the earliest stage. So what are some of the basic, the very initial financial model? At this point, you probably don't have big old macros and all those kinds of things built into your spreadsheets because you don't know yet, right, where you're headed. So what are some of the high-level components of data that you think people should focus on in that first step?
Yeah. So
the actual selling.
The first hot take I'll share, and I heard it two different ways, but I think it's really interesting to think about is your financial models tabs, the number of tabs within your workbook should either be the number of years old you are or the number of $1 million you've raised. So if you've raised less than $1 million, your entire pro forma should live on one tab.
All right. I've never heard you say that, and I agree with that, and I love that.
One tab.
The number of tabs on your financial model should equal the number of years or every $1 million
that you've raised.
That's the complexity.
Because if it's more than that, you're making assumptions about things that you don't know to be true.
Right.
And the simplicity of telling your story on one page, you say this all the time, right? The simplicity of telling your story through data on one page forces you to think about what's most important. And so going back to sort of that learn and iterate with pre-seed dollars, I'll actually reference a study that I find really interesting. And it's all over the internet. You can Google it. You can check your LinkedIn, but it's people are toying with this concept now that everyone's favorite topic right now is this intersection of data and finance and what role AI is going to play in helping you understand what's happening in your business more so than ever before. Well, the studies now are like, when should companies hire their first finance hire in-house? And I am just absolutely bewildered by the responses.
We've met we've met pre-rev startups that have CFOs.
36% of the respondents say that you don't need one until after $25 million in run rate. I think that's absurd. 31% between $10 and $25 million. That is crazy. It's crazy. Because if you are the person who builds it or the person who sells it, most likely you're not wired like this.
Right.
And so when we think about being honest with ourselves and kind of assessing strengths and weaknesses of the founding team, you either understand what's going on in your business or you don't, and you need to fill that gap a lot sooner than what some of these studies will tell you.
When do you think that enters into the equation from the finance standpoint, and how do people bridge the gap in those early days on the data side and on the finance side?
That's a great question. I know you're going to hate this nebulous answer, but like every situation is different.
Yep.
Right. And if you're that high flying visionary that likes to spend, faster than you get it in, then you probably need them quick, right? To help you learn and iterate and invest accordingly. But if you are someone like you, Toph, who really, I think, flourishes in the go-to-market side of businesses, but understands very intimately what's happening in finance and operations, the underlying organizational metrics. If you're that type of founder, I think you can hold off for a long time because you can outsource some of those functions and get enough of what you need to be able to trust your gut in those situations and tell the right story to the right groups at the right time. But every situation is different. So
on the data side, you could go to someone like a Growth Heroes that we've used.
Totally.
Right? To help you think about how you would architect that from the early days, or an Opstart. In full disclosure, we have an investment in Opstart, but to an Opstart who can help you with some of the high level, back to your one tab, simple model so that you always have some kind of a North Star that you're working towards. And I also want to mention the one pager you mentioned a moment ago, just for the viewers out there. That one pager basically is structured with the BHAG, up in the left-hand side, like, Toyota back in the 60s was world domination.
Yeah.
It had nothing to do with cars. But you have your BHAG, and you have on the upper right-hand side, you have a theme for that quarter that everybody's rallying around, whether you're a single, solopreneur at that point, or you have a team of 3 or 4 or 5. And then you work yourself down to like 3 or 5 years. Like, what does that look like? And then what I want to do this year, and then what I have to do this quarter, and it all rolls up. And what I have to do this quarter is broken down by department.
Right.
And so, like, every business in the world should have the ability to be run from one page. And if it can't, you're doing too much, is the concept.
Yep. And so you ask about what metrics are most important. Take that one page and the goals you set for those quarters.
Yep.
And tell me whether or not you've achieved those things. Forget
Yes.
all these acronyms.
Right.
Forget all these words.
Yep.
GAAP revenue, non-GAAP, expenses, accrual method, cash, whatever. None of that matters. If you said you're going to go do something in a month, I'm going to have 100 customer conversations.
Yep.
Then what metrics matter? Well, how long did it take me to get a customer on the phone? How long did I talk to the customer? What type of feedback did I get? How many of those 100 did I actually have?
Yep.
Those are great metrics around one goal that you'll never see on slides like this behind us. Super important, because now if you go raise $20,000 because you want to have 500 customer conversations, you're going to be able to tell an investor it's going to take me 9 months. I'm going to do 125 a month. And if I miss, I'm going to miss by 50. And that 9 months is going to ensure that I have plenty of runway to go have those 500 conversations. That's all I'm going to do with that 20,000.
What you just described are the very initial stages, early stages of unit economics.
That's right.
It all comes down to unit economics.
That's right.
So as you build this thing up, can you defend every step of the way? When we get to this top layer in a moment that we'll get to, but can you defend those numbers, right? Because the investors that you talk to, if they're sophisticated at all, they're going to start asking some questions, and what those assumptions are. If it's in your DNA from day one,
Yep.
you will be able to answer very specifically with numbers. I've assumed A, B, C, D, E, F, G.
Yep.
And that always changes, by the way. We no longer set strategies a year in advance. Like, strategy should be up for discussion monthly, maybe even sometimes more often.
Yep.
But understand those things at every single step of the way.
Why I love that one tab pro forma so much is you start with the things that you know.
Yep.
These like inalienable truths about your business. You hired your first employee, they signed an offer letter. That salary's fixed. It's not going anywhere, right? Known. And the more known data points about your business in its early stage decreases your reliance on assumptions, things that you're going to go test.
Yep.
People want to know what's true and what you're guessing,
Right.
what you're assuming to be true. And the shorter that list is, the more successful you'll be, because you have less things to test. When scientists are testing things, right, they try to have a number of control variables. Same thing here, right? We don't want too much noise. There's only a couple of things you can test at once to understand what levers you can pull to change those outcomes.
This like boils down to this one-liner people are probably sick of me saying, but this all boils down to driving the imperfections out of your business.
Yeah.
Like at every step, right? In every function, driving those imperfections out of the business.
I think the most important takeaway, no matter what profile you are, the visionary, the killer go-to-market profile, you end up buying the tools, basically day 1 or 2, that give you an ability to lay this foundation. And oftentimes we stop short of actually implementing those things, right?
Yep.
So what's a common tech stack we hear about all the time? Well, I got QuickBooks, I got HubSpot, I got Ramp, and I got fill in the blank, Carta. Okay. Well, is HubSpot connected to QuickBooks? No. Why not? Imagine what would happen if you knew that you sent an invoice, had a follow-up email, and the customer paid you.
Right.
Then you wouldn't have to track DSO or accounts receivable days in Excel. You'd save yourself an hour, right? You could just have a dashboard in HubSpot. It's already pre-baked and built. It takes a couple of clicks or working with a group like Growth Heroes or others, right? There are many.
And thinking about from day one, so you mentioned QuickBooks, for example, but when you're setting up your systems from day one, tracking everything at the granular level, it's always easy to roll it up.
Right.
But it's really hard to pull it apart. And so, like, when it comes to revenue, right? If you have a services component, track that separately. If you have a services component that's one time setup versus recurring, track that separately.
Yep.
Right? The software, or if you have a piece of hardware that you're selling, like all these components should be tracked separately. It gets to cost of goods, same thing, right? Use this thing called Google. Actually, sometimes people I've heard recently aren't even using Google anymore. They're using all ChatGPT for their searches. But you can very quickly get an idea of like what should you put in COGS,
Right.
or not.
Right. I mean, hell, that's full disclosure. That's how I learned, right? I came from public accounting.
Yep.
But there were concepts in recurring revenue business models that I was learning for the first time on the job. Like, you can do it too.
How'd you learn it?
Google.
Yep.
I mean, back then, 2011, 2012, our understanding of some of these metrics that we sort of live and die by as investors today was very nascent.
Yeah.
We just didn't have that many examples. We didn't have, a sample size large enough to understand the impact of Rule of 40, Rule of X, Rule of 50, the way that we do today. So, I mean, it was a little bit better than Wild West, but both sides of the table were trying to negotiate, the impact of NRR on future growth.
And always remain curious, right? Because I used to get made fun of by some folks because I would always Google about every 6 months. I would do a bunch of random Googles around like, what are the most important SaaS metrics?
Yeah.
And you would learn because these new concepts, either get invented or come into favor, others fall out of favor. And so always being just have an insatiable appetite for curiosity, and like whatever you know today, don't think it's going to be true forever because it could change tomorrow or in 2 months.
Yeah. And I think that applies to the point you just made about like, it's a lot easier foundationally to have, as much granularity about a thing as a starting point and then aggregate later as opposed to disaggregation downstream.
Yep.
It gets real messy real fast, right?
Yeah.
We just live through that.
Right.
Here at Elevate.
Yeah.
And so it's as easy as if I'm an entrepreneur thinking about, okay, I'm going to send this invoice. This invoice has a couple of line items. What do I wish I would have known a year later? And if we flip to the next slide, I think this is a perfect sort of launching point to this concept of future backwards. And you think about metrics the same way. Again, these don't have to be the bright and shiny metrics that an investor's forcing you to track that you don't fully understand. This goes back to like, how many customer conversations did I have this month? That's a metric.
Yep.
Right? Simple. But what is it about those customer conversations that you wish you would know a year from now? Well, what industries were they in? What's some of the demographic information about the person that you talk to? Why does that matter? Are they part of your ICP?
Am I going to interrupt your train of thought if I add a thing right there real quick?
Go ahead.
On your customer, like customer segmentation. So I was in the entrepreneurial master's program at MIT years ago, and I'll never forget. Some professor came in, and you've got 60 entrepreneurs from across the globe, right, in this class, and we're in there for over the course of like 3 years. And one of the classes, he came in. And we're going to talk. He said, "We're going to talk about customers today." And he goes around the room. And he said, "I want you to all tell me who your customers are." And there's businesses in there from, a couple $1 million up to one was $1 billion business. And so he went around the room, and everybody's, they're all proud. Here's my customer, and goes around the whole class and get done. And he's like, "Everybody's wrong. None of you know who your customer is." And I can't remember the exact example he gave, but it was something to the akin of this. Let's say you're selling software into car dealerships. And so you're like, well, my customer, are car dealerships in the United States. And he's like, no. Your customer are car dealerships in the United States that sell at least, 100 units per month. And they have a service manager that reports to a service director. And it's only in, Ford dealerships. Or whatever. It's like this concept of narrow and deep.
Yeah.
Right? It's not all customers. It's not all dealerships.
Right. And that goes back to like the simplicity of trying to, in every action that you take, trying to tease out this sort of granular understanding of what you can learn from that.
Yeah.
Those are the early metrics. That's what builds the foundation. And as you aggregate those things up, then we start talking about the investable metrics that matter. As you scale your company, those metrics that you hear about all the time, ARR, GRR, NRR, growth rate, CAC, LTV, sales magic number, rule of 40, all of those start to come into focus. And what that does for you is it allows you to think about the future from today and say, all right, I know
this is the start with the end game.
That's right.
In mind.
And I love this so much because this behind us suggests that most founders, the builders especially,
Maybe
get stuck on this level one.
Walk the listeners that maybe you're just listening to this on audio. What this?
Yeah. So we have a cone, a cylinder looking cone where the base layer is this product level understanding of your business, right? It's feature, function, it's pricing in some aspects, and the next level up is distribution. How do people buy this thing that you built? And the very last, the tip of this cone, is about capital strategy. And it goes on to say, if you read Chris Topman, a partner at Notion Capital who came up with this idea, it goes on to say that entrepreneurs and founders, they hardly ever get to level 3. They get stuck on either level 1 or level 1 and 2. And they don't understand the impact of those product level metrics and understanding, or the distribution go to market level metrics and understanding on their capital strategy. And what ends up happening is what? Down rounds, flat rounds, all types of pay to play. I mean, it just gets real dicey real quick.
Bridge 58.
And level 3, this concept of capital strategy is really just about thinking future backwards. So I understand certain things about my business, whether it's customer discovery calls, or it's pricing model that we think is starting to take hold, or it's adoption metrics from the product side of the business, right? And it sort of rolls up into these metrics that we talk about often, certainly as investors, but that you'll see as entrepreneurs asked from you as part of due diligence in a fundraising round. The top 10, right? We've covered off a number of times, but we're thinking about, what aspects of your revenue install base are recurring versus not. We're talking about growth rate by product line or service line, even better.
Yes.
We're talking about gross margin. How much money is left over to pay for other stuff. By product would be awesome. By service line would be awesome. We talk about how sticky it is, gross retention, both from a logos and a dollar perspective. We talk about what the upsellability, your net retention is. Can you sell them more stuff? Do they love you enough to continue buying more stuff from you as you deliver it? We talk about revenue concentration. And these other metrics. What that does, though, it provides a benchmarking framework to say, all right, if I'm going to go tack this massive TAM, this massive opportunity, I'm going to go solve all the world's ills. It's likely that this first couple $1 million in this seed raise isn't going to get it done. And I'm going to have to raise money again, sometimes 2, 3, 4, 5 more times. Well, if I'm going to raise $2 million today in a seed round, and I know that in 24 months I'm going to have to raise an A, I have benchmarking understanding of what those Series A profile companies look like.
Yep.
Right? What good, better, best looks like from a growth rate perspective. What good, better, best looks like from NRR perspective. So how am I going to leverage the $2 million I just raised over the next 24 months to make sure my business's profile looks like theirs? Because I know I'm going to have to go to market and raise capital again, and I don't want to look like the ugly stepchild. We have that information. We just oftentimes don't think about it. This third layer of the image behind us, the capital strategy, future backwards to today, how we should leverage those metrics to inform our strategy from a capital perspective. Ultimately, that means downstream, we own more of the business than if we did.
So a couple of things I want to mention there. So one is that we see a lot of companies, the way we used to go to market, you mentioned Salesforce, for example, but the way we go to market 25 years ago, 30 years ago, even 10 years ago, is not the same way we go to market today. Several years ago, I was at an event and heard Brad Rencher, who was the GM of the Adobe Creative Cloud, and what was the company that they bought? He was with that company previously and then became the GM of the Adobe Creative Cloud. And he said that something I thought was spot on. So remember the PLG days? So PLG came about in about, I think, 2016 was when the first one emerged. And was that Slack or Atlassian? I can't remember.
Slack gets credit a lot.
Slack.
I think it was one of two, yeah.
And then in 2017, there were maybe a half a dozen. And in 2018, there were 100.
Yeah.
And in 2019, it was a whole list of them.
Well,
And so this go-to-market, so back to why we were talking on the previous slide, we were talking about the critical need for the granular data. How long does it take you to go do these very basic things? Like, it's really back to the basics. But we hear a lot of companies that will talk about, my go-to-market strategy is PLG and enterprise and channel partners all at the same time. And you can't execute on all three of those at one time. You'll never talk about capital strategy. That is a great way to have a lot of bridge rounds and probably ultimately go out of business. And many companies never do two of those strategies, right? Let alone all three of them. But those early PLG companies, and people would point to like Slack or whomever and say, well, they have an enterprise strategy. Well, it took them 5+, maybe more years to get there. But back to Brad Brencher real quick, and I think we're going to see something similar with AI. But his belief of why PLG came about is because all of the original SaaS companies, their tentacles are so deep inside of these big enterprise players. You could build the best platform, the best enterprise resource known to humankind. You're never going to displace them out of the gate. Not going to happen. And they've been acquiring so many people over the years, bolting on. But we got taught by the iPhone, by the smartphone, that everything user-based, so PLG is selling to the user, not the buyer. And so we got trained by the smartphone that everything should be super easy, kind of one click and go. And there should be it should be free. And so that's in PLG models, the whole freemium and free trials, all this stuff came to be. And now, with who knows what that's going to be in this transition with AI, but going back to capital strategy, like whatever that go-to-market motion is, pick one.
Yeah.
Is the concept, right?
Yeah.
And it may not be the right one, but prove it out.
Yeah. Yeah. So we talked about earlier the importance of the control environment, right?
Yep.
Like you can only test so many things at once before things get too noisy.
Yeah.
Well, if you're trying to measure and iterate against 3 distribution strategies or 3 go-to-market strategies. You got a PLG, you got an enterprise motion, which is inbound, outbound, all bound is the new term du jour over there, but it's basically people selling stuff. Yep. Or channel partnerships, affiliates, those types of things. You're only going to get so many data points across those 3. Every piece of information you have is divided by 3. The impact of the impact of that data is now divided by 3. So the benefit of sort of narrow and deep and focusing on one is that you've increased the number of control variables, the knowns, and you've decreased those list of assumptions. Yep. And you're literally going to test and learn something very specific, and you've cut out a majority of that noise. So incredibly important. Not to mention, you can only sit on one toilet. That's your favorite. One of your favorite quotes, but like you can really only focus on one thing. I mean, it's like human nature. My wife tells me all the time I can't multitask. Like I believe her.
That's too funny.
So like, not to mention that you can only focus on one thing. The benefit is that you've limited the number of assumptions that you're testing.
Another thing in that future, or the future backwards concept is when you're talking to VCs, they're going to be looking at that model. And they're going to tear it apart, right, to see if the unit economics stand up. But also, between rounds, the VC's looking for at least a 3x step up.
Right.
And so with your financial model, maybe even 4x. And so in your financial model, if you don't know how much it costs you to gain a customer in all facets of every single motion of the selling or marketing process, and so you have a solid foundation from which that financial model is built, so that you can, with some level of certainty, maybe that's the wrong word because things always change, but with a straight face, you can defend that model when the VC's looking, does it step up 3 or 4x? Because we kind of see one of 2 extremes. We see there's a 1.5x step up at the next round, and that's why you get silent no's, we call them, from VCs. Yep. Or it's like a 20x step up, which is not believable either because there's not enough data to back up those assumptions.
Yeah. Peter Walker from Carta?
Yes.
You're bringing to Rally this year in September?
Yep.
Why are you bringing him to Rally?
because he has incredible data.
He has data about how investors think.
Yeah.
So either we, the entrepreneur, the founder, can go tell this story future backwards of our capital strategy, or the investor's going to build their own.
You know,
And
what
they're
he
going to
said
do that by taking your data and crafting their own narrative.
You know what he said in the conversation? We just had a chat, kind of planning for that. And he said something that I thought was really very scary. He believes that the knowledge base that entrepreneurs have, that founders have about how VC works, he thinks that gap is widening, not narrowing, which is one of the reasons we're sitting here today having a chat to share with folks.
Why does he mention why he thinks that is?
He's not sure yet, and so we'll maybe dive into it more. At Rally, we're going to be talking about, we're going to spend a little bit of time on kind of these high-level data points and metrics, but then talking about how to close that gap and to help give founders and entrepreneurs a better understanding of how to be thinking, in game, in mind, to help them be more successful raising these rounds of capital. And quite frankly, if you're an entrepreneur today, at this very moment, in the last, I'll just say the 12 months, LTM, another acronym, but in the last 12 months, and maybe even 9, the rate of acceleration of change, I have never seen anything like it in my life. And, and this is going back to before the dot bomb, I like to call it. I started my very first company in 89, and then the next one started in 2007, I think it was. And so that's when the invention of the internet came around. Right, and was rolling out. And that's nothing, I think, compared to the rate of change we're going to see today. And so, there's no such thing as a moat anymore. There's no technology moat. So what is the moat? The moat is like distribution, you said earlier. How are you going to get that product in front of people who are going to buy it and buy more of it? And execution. And execution goes back to the granular motions of go-to-market efficiency.
Yeah. It's so we get to see 600, 700, 800 pitches a year here at Elevate. When a founder's convicted, you can tell.
Yes.
Almost straight away.
Yep.
Right. When they understand at a granular level what they're going to take your money to go do, it just screams off the page. It doesn't matter what their pitch deck looks like.
Yep.
And it's not an arrogant confidence either.
Yep.
It's conviction.
Conviction.
And you can feel it. It's palpable.
More data, more conviction.
And so everything that we talk about here, I want to cover off on one other thing that you said. And you were talking about the importance of understanding cost to acquire a customer as one of the most important data, early stage data points to taking institutional capital. The other thing that I'll say, and it goes back to Peter Walker's comment about the gap sort of widening about our understanding of venture is there are many slivers to venture capital.
Yep.
There are many slivers to the funding continuum. There's crowdfunding to angel rounds to early stage players to a little bit later than early stage players, but still super early. There's, Series A investors, B growth investors, PE, iBanks, the whole gambit. It's really important that we understand who the audience is that we're targeting for the type of capital that we want. Do we want capital to go try stuff because we actually don't know the answer?
Right.
Those are probably the 2 or 3 or 4 groups over here that are used to that. So that when you go pitch and say, I actually don't know, but this is how I'm going to go test, and this is how I'm going to iterate. They love hearing that. That's what they bet on.
I was just going to double down on that. If you don't know the answer, that's hopefully some of the baseline answers But if you don't know the answer in a conversation, it's okay to say, you know what? I don't know, and I'm going to get the answer, and I'm going to come back to you.
Yeah, there's no better answer, in my opinion, than this is exactly why I need your money, because I'm going to go use your money to go learn in this way, and this is how I'm going to measure success.
Go do A.
Then when
B,
I learn,
and C.
I'm going to come back here, and we're going to invest some more.
Yeah,
sweet, go do it.
Yeah,
all day long.
What? All right, so are there any points that we didn't cover off on? So now, let's say I'm a $15 million company. And I think I know my metrics, but I don't. Maybe I've had who knows what's going on. Maybe I've had some failed raises, rounds of capital, or maybe it's even at 20 million. But what are some of the What are some of the thoughts that go through your mind on, even though you've made it to 10 or to 20 million, and maybe you haven't done this. These are present day companies right now doing 10, 20, maybe even 30 million. What risks do they have if they don't start disrupting themselves right now with getting control of their data, marrying that with the finance function, and maybe even disrupting themselves with modern technology?
In my mind, and I'm biased, and we talk about this all the time, and I think I've sold you, and it didn't take much selling. There is not a price that you can pay for data visibility and understanding. Okay. Especially as you think about a future that's changing faster than ever before.
Yep.
If you don't understand what's happening in your business, okay, you're going to spend all your time working in it instead of working on it. That's a quote that you like to say.
I love that quote.
And so going back to like, okay, if there's not a price you can pay for data visibility and understanding, you got all these people talking about when to hire a CFO. Like, my argument would be that these roles pay for themselves. There's like never a business case you're going to show me that suggests that you can wait if you don't understand your business.
Right.
Like, the time is now. If you don't understand your business, if the questions that we're asking,
you're flying a jumbo jet, nobody's sitting up front.
Yeah, if the questions we're asking perplex you, then you got to go engage someone who knows the answer.
Yep.
Like, now. And we could talk about outsource and insource or whatever. I'm a huge fan of tribal understanding. I think water cooler conversations provide a level of context to your understanding that you can't get any other way. But outsourced talent can be valuable for certain chapters within your growth story. They're never the long-term fix, but they can be really solid short-term fixes. But people ask me all the time, like, what are some of the biggest mistakes you made as an operator at Smarter HQ? And I tell them all the time, I waited too long for two roles. And I'm finance and ops, right? So I was employee number 8. That's an example of a company whose 8th hire was in back office. Not 25 million in run rate, 8th hire. The two biggest mistakes I made: sales ops, product marketing. What do those two people focus on? Data. Data, pricing, competitive landscape, motion, distribution strategy, efficacy of those investments in your go-to-market channels, right? If I had visibility into that earlier in that story, the levers I could pull with that information would have been insane.
I love that. You just made me think of, sales ops and product marketing. I wish I could remember who I was talking to that brought this up, but we've talked about this before as well. Many companies, founder-led sales and the transition to process-led sales. Many times, well, in a high level, founder never quits selling.
Yeah, shouldn't.
But I've made this mistake myself, but many founders will think they have it figured out. They've got some false positives. And so everybody goes to, I'm going to go hire a CRO. And I'm going to go find someone who has crushed it, that works for, name it, insert name, massive enterprise company. And they hire those folks, and it's a $300,000 OTE or $400,000 OTE or something. And things aren't working out, but it's going to work out. And, basically you're a year, maybe 18 months or 2 years down the road, and it doesn't work out because that's the wrong skill set, right? Those folks forgot how to make coffee. And quite honestly, the sales motion is not really figured out. The messaging, right? The value prop's not really figured out. People are buying from you as the founder who's convicted.
Yeah.
Right. And can tell that story. And so the concept is that first sales hire maybe should be a sales ops person who is tied to your hip for a minimum of 6 months. Minimum. And is writing down every single thing that happens, the questions and the answers, et cetera, and is building that playbook.
Yeah.
So when you do make your first hire,
the hardest thing to translate, the hardest thing to legislate as you think about moving from founder-led sales to process-led sales is passion and conviction.
Right.
And so the founder, the selling founder doesn't even understand how dynamic they are in the moment.
They don't even know what they're doing.
They don't.
Right?
It's just like I
They're in the
set out to
zone.
sell this thing 10 times. Like, you wake up one day and you either sold 10 or not, and you
Right.
really don't know how you did it.
Yeah.
Go imagine trying to teach somebody now.
Yep.
Right. And so that in my experience, we can call it CIOs, we can call it CFOs, COOs, BI, sales ops, product marketing, like pick one, like somebody who is following you around and understanding what you do and how you do it, taking copious notes. And if we're lucky, systematizing your understanding
Right.
of what you do and how you do it
Yeah.
is going to make that transition more possible.
Yep.
And so oftentimes what do? We hire 2-3 BDRs, we hire 4-5 AEs and someone who forgot to take out the trash.
Let's fire up that machine.
Nobody's taking notes. Best case scenario, somebody's following along in Excel, building Salesforce in Excel.
Right.
To what end?
I love it. All right. What have we not covered off on today? Any big topics? I mean, there's all kinds. We could talk for 8 hours on this topic.
No,
but,
I mean, we're going to come back and do this again ultimately, but let's just not forget, like the world of financing businesses, buying and selling and trading, like it hasn't changed that much. When we were in school, we talked about, businesses, traditional businesses, one-time sellers, widget makers, right, at 3 to 5 times EBITDA. Like, why were they trading at that price point? Well, it's because we were going to give you some money, and over 3 to 5 years, we're going to earn that money back. And hopefully more, right? That's what makes a good investment. And then we were starting to sell CDs. AOL was starting to sell you a CD every year. So you could get on AIM and chat or whatever. You had your first email inbox that required you to download this thing that you would pay for every year. And that kind of changed our understanding of what was possible, or the premiums that folks would pay, because now you're buying the same widget over and over and over and over and over again. And so all of these like revenue multiples, right? If we actually distill those things down, the same principles apply, which is like, what am I willing to pay for this recurring revenue business such that in 3 to 5 years, I can measure whether or not this was a good investment. And so a lot of the things that we talk about, like my push onto everyone listening is just like, don't forget the basics.
Yep.
Right. It's like these things have been around forever. Now we've kind of confused everything with acronyms and big words and gap or not and all types of things. But at the end of the day, I always use the reference to real estate, right? Like, the price of your business is what the market will pay. The price of your house isn't just what the appraiser said it was worth. It's what the person buying the house is willing to pay you. That's it. Right. And so let's just not forget that in the midst of all of what is scary or confusing. At the end of the day, like, you can always get to a level of simplicity to help you manage through it. It's so important.
So in summary, data hygiene starts at the granular level, and then your go-to-market motions, measuring everything. How long does it take you and how much does it cost to get to that end game, whatever it is. And then you've got the performance metrics that you're measuring. And then ultimately you find yourself to investor metrics.
Yeah.
And then start with the end game in mind and how you're going to build your business. Be very intentional about going narrow and deep, picking a go-to-market strategy. There's no moat with technology anymore. Embrace AI, embrace modern technology, and Google or use ChatGPT a lot.
Yep.
Educate yourself. What'd I miss?
Just, it's really hard to change things that you don't measure.
Yeah.
And metrics come in many forms and fashions. We tried to highlight some really easy ones, right, today. But it's really hard to change something that you can't see.
So data hygiene and financial hygiene, that intersection drives the imperfections out of your business and puts you in a much better position for better outcomes.
I'd argue it's a discipline that pays for itself.
I love it. All right. Well, Matt, this has been awesome. Hopefully all of you enjoyed it out there, and hopefully you learned a few nuggets along the way. Matt Tyner, Managing Partner, Elevate Ventures. My name is Christopher Day. Now that we're friends, call me Toph, CEO at Elevate Ventures. And we'll look forward to chatting, going deep on some more topics here in the future.
Yeah, would love that, man. Thanks for having me.